Maverick Traders. Welcome out to your trading room as we prepare for the week coming up, May 1st through the 5th. Let's get into it. And there's plenty to talk about. The markets pulled back initially last week, but ultimately we're setting up for an upside move. And as we've discussed previously, the moving averages are still upward sloping. We've been trending above them. And what developed in the S&P 500 is a cup and handle pattern, which we'll discuss. On that pullback, we got bullish on that dip, really anticipating a nice pop to the upside, and we got that at the end of the week. So the data came in really pretty good for the bulls because GDP missed. Now you might think, well, that's a negative. GDP missed at 1.1%. The expectation was for 2. That's a bad thing. Well, remember, sometimes bad news is good for stocks. In this situation, the GDP missing is good because the markets say, well, the Fed's going to be on hold a little bit more, less aggressive with rate hikes, less quantitative tightening, and so on. So it's more about what's going to impact the Fed. And then also core PCE and inflation gauge came in at expectations. So those were both pretty good for the bulls. The large cap tech really fueled the upside move. Strong earnings reactions in Meta and Microsoft, but others as well. So large cap tech, the most important piece of the market because they're the biggest weighting in the S&P 500, hit on all cylinders, most of those stocks surging to the upside, and that really pulled the markets up. As we look at the data, as we said, advanced GDP, big miss, and then the core PCE. Those were two of the hurdles that the U.S. needed to get through, and that came in at expectation. So no big uptick in the price index is a good thing. Now let's talk about where the markets are at, where we might be going here. The Dow, the S&P, NASDAQ, pretty good week. NASDAQ was the strongest, as we said. Large cap tech really fueled the upside move. The Russell 2000 finished slightly lower, oil down on the week, and gold flat. Now, as we look at the charts, what stands out to me, again, is this cup and handle pattern. When you look at the S&P 500, and this is the ETF, but you can see the pattern in place. You can see the resistance zone that was established back here. You can see the big drop that followed. You can see the subsequent recovery and retest, and that's important. Now, when you first go up to resistance, of course, there is overhead supply. There's a lot of people that said, hey, this derailed the market previously. Let's go ahead and lock in profits. Let's sell. You get some short sellers that are willing to short against resistance and so on. And normally when you've expended a lot of energy just to get up to this zone, you're not just going to go zooming right through. There's going to be a back and fill. A little shakeout is really what's happening here, a little mini corrective pattern. And so resistance holds initially. We back up, but as we back up on this pullback, ultimately there's a lot of buying pressure that comes in on this pullback. Now, some might say, well, couldn't this have been a big double top? It could be, but I don't really bank on it being a double top. You'll know it if it evolves into that. But usually these are signs that are all bullish. Look at the upward slope. Look at the 20 crossing above the 50. So this is the shakeout zone. And this pullback, when it gets down about 30% of the size of the cup. So if you just measure from resistance to the bottom of the cup, and then you do the math and say, well, this is 30%. It was about right in here. That's where the market should encounter buyers. That's where the buy the dip shift takes place. And sure enough, it came in aggressively. Thursday, Friday, finished on the highs. Not quite at a new breakout, but that breakout looms. Now, one thing that you can also do is a measured move approach for your target. You can take the size of this handle and flip it this way and say, okay, the SPY pulled back from about 416 and came back here to about 404, let's call it. It's not an exact science. Well, that's about 12 points. As we break out above 416, we go about 12 points higher to 428. So 428 or thereabouts is a good upside target for the S&P. Look at the Nasdaq. It has broken out. Nasdaq 100 finished on the highs on Friday, broke out to new highs, led by Microsoft and Meta specifically. We've got Apple earnings coming next week, but the market just really took us, kind of breathed a sigh of relief and said, well, this was a better earnings report, better earnings growth, and a lot of the things that we were worried about have not come to fruition. That collective sigh of relief, and markets rebound accordingly. The VIX is in pullback mode. It's really been trending lower. You had a little bit of a jump up here, a spike, and now it's back in fill time in the VIX. So this coming week, the cup and handle pattern is still there. For me, I'm remaining bullish, and I was looking for an opportunity to buy that dip last week and got it with that cup and handle. Now the question is, well, when do I stop being bullish? One factor that would really have me hit the brakes and take profits and do some things where I would get nervous if we had a blow off top. And a blow off top would be a move where not only do you break out to the upside, but you get overextended. The price action basically goes parabolic. And as it goes parabolic, the volume just surges and so forth. So volume abnormally high, 2 times, 3 times normal volumes. The price action get way extended away from the moving averages, etc. If we have one of those blow off tops, and I don't think it's going to happen within the next couple of days, I'm talking about in the coming weeks, that would be for me a really strong signal to basically lock in profits, get neutral on the markets at least. It's a profit taking signal much more than it's a signal to like short the market. That would be quite aggressive. But if I get that big runaway blow off top in the markets, I'm going to change what I'm doing, no doubt, and get a lot less bullish than what I am. Tuesday, we've got AMD, Pfizer, Starbucks. Wednesday, CVS and Qualcomm. Thursday, Apple, Bud, ConocoPhillips. Friday, we put Berkshire Hathaway here, but Berkshire actually reports on Saturday. It's kind of weird. They report over the weekend. Cigna, Johnson Controls, and so forth. So plenty of things. We're still in the heart of earnings season, and of course, Apple is the big headliner there. So as we look at the economic reports, we've got ISM manufacturing on Monday. And then, of course, the big news this week is the Fed meeting coming out on Wednesday. That is going to be a market mover. The expectations are that the Fed will hike by 25 basis points, and that is it. That is basically the top in the Fed rate hike cycle, that will be the peak Fed funds rate, and from there it can back up later this year. You also have an ECB meeting in Europe. Then on Friday, we've got non-farm payrolls. Payrolls number, always important. That will be backing up with the Fed's Wednesday meeting. So a lot to look at. I mean, Apple earnings, we're still in earnings season. You've got a Fed meeting. You've got non-farm payrolls. Just have a lot of things this week. So it's going to keep you busy. It's going to keep you on your toes. There's going to be volatility potentially in both directions. Now, weekly outlook, monthly outlook, still bullish. We're above the 20, above the 50. The slope is improving. Certainly the 20 is upward sloping, and the 50 has more of a sideways to slightly upward tilt to it. Let's look at some sectors. So as we break down the sectors, big time outperformance in communications. Meta is part of that. And Meta, formerly known as Facebook, certainly fueled a lot of that. And we talked about large cap tech, the Microsofts of the world and so forth. Really strong price performance. Real estate also with a bounce back week. Utilities underperformed, but for the most part, really led by the biggest, most important sectors is important. You're going to see a lot of zero ratings as we go through the various sectors. So utilities, it's more bullish than bearish, certainly. Just look at the upward sloping moving averages, but we have this at more of a neutral. It was the weakest performer, and it's just not someplace you want to be for a risk-on environment. If the market's going to go higher, there's just better places to be. Communications, like we talked about, this is strong. +2, already broke out to the upside. Good upward price pressure, good price action in that sector. Real estate, nice improvement getting above the moving averages, but look at how neutral and sideways they are. Look at how we're still inside of the trading range. Still some choppiness there would be anticipated. Industrials with a nice rebound. You really need an industrials to get above this downtrend line and get out of this symmetrical triangle pattern. Still pretty much range bound at this point. Now, I do think what should start to happen is market breadth should start to widen out, and some things like industrials should start to break out to the upside. This is a spot where some of these sectors have lagged, but now that the market is breaking out, you can really have people getting nervous if you're short the market. And that nervousness fuels the upside move, and they've got to be on edge with the NASDAQ breaking out, the S&P. They're going to be inclined to bail out on this market, and that filters through to some of these sectors where they're short and so on. Then there's also the idea that maybe people don't want to chase large cap tech anymore, but they're underperforming as the market's going higher and they're not bullish enough. What do? They might come back and look at some things that haven't moved as much. Healthcare, still upward trending, definitely. A little bit of a step back early in the week and climbing back up later in the week. +1 rating there in healthcare. Financials, still just choppy. I mean, it had a rough time back here when Silicon Valley Bank went under. It looks like First Republic is going to be essentially nationalized or whatnot, taken over by the government. Financials still in a choppy sideways environment. Consumer discretionary, same thing. You're noticing that it's the large tech and those names that are really fueling this, and a lot of these other sectors and markets are in sideways patterns. Here is tech, and tech is better than most. Certainly above the 20. We've got some good upward slope here. We're on the cusp of the breakout here in tech. And then materials and energy to round it out. Materials starting to bounce back late in the week, but still just sideways. Look at this sideways slope here. And energy started to bounce back late in the week, but again, you're just not decisive. Now, I do think money should theoretically come rotating back in. If you want to look at energy, it looks pretty good having held at this gap zone. This was the area where energy gapped up on some news that Saudi Arabia and the UAE, that area is basically going to cut down on production of oil. Oil prices spiked sharply higher. And then we back and filled. You bounced right on the gap fill. That's pretty technical, technically solid. I would anticipate energy should start to see some fund flows coming back in as an example. If you want to continue to trade the outperformers, communication services, tech, and healthcare. But watch for this rally to broaden out and for some of those underperforming sectors to potentially catch a bid. All right, let's get into some possible trades here. Starting in the real estate market, first from last week, we had Cube as a sideways trade. It's really pretty sideways here. I mean, as you can see, it hasn't moved much, down slightly, 0.5% on the week. Now, new idea, EQR, another sideways possibility, 60, 65, 50, 70. 65 is a little higher, so you could call it slightly, mildly bullish, anticipating that it stays between 60 and 65 in that May expiry. EQR, again, more of a sideways idea. Communication services, one of the better performing sectors. Here's EA, which we had on the long side. It actually was down 1.4%, and it got hit as Activision's deal did not get approval. So Activision not being bought out by Microsoft, it looks like, and all of these gaming companies really took a hit accordingly. Take-Two Interactive, Activision, of course, was down the largest, and then EA all got hit. New idea, EDR. Possible trade would be a bull call spread. Again, not super high aggressive, but maybe targeting a move of a couple of points higher here. Ultimately, high basing here, and expectation would be another upside push. Healthcare names. So we had Gilead as a possible long, and again, hit by news here in healthcare. Big down move, down 5% on the week from the highlight of Gilead last week. Possible ideas, Intuitive Surgical, May diagonal spread here, looking for a little bit of upside towards 305 through the first expiration, and then kind of seeing from there. You could do the May 19th and just do this Friday's diagonal, test the trade out. If it's working, maybe you stick with the long call thereafter. In the industrial space, last week we had VRT on the short side. This one exploded higher, gapped up on some earnings, and continued to work its way higher, up 22% on the week. Possible ideas for new trades, TREX highlighted May 50, 55, 60, so just completely neutral, anticipating that it finishes right around these levels for the next couple of weeks. Financials. So last week we had USB on the short side. This one was up 2% on the week. All of that, of course, happening right at the tail end of the week. And it was pretty interesting that a lot of these regional banks actually held up pretty well once the FRC news really was digested by the markets, and it looks like there's some form of solution, in essence, of taking over their assets, and it's not going to spread further from there. Not new idea, Riot Platforms, bull pullback here. You could play a May 12 to 14 type of call spread. Play it to move back up towards that resistance zone, basically. Consumer names. So last week we had Foot Locker, and this one basically sideways, and it was in essence sideways, up about 1% on the week, still kind of stuck in that basic range. GOOS as a possible new trade idea, May 1950 2050 bull call spread, not targeting a lot of upside, but basically a push up here to a new swing high. Little bit of a bullish cupping pattern, and if it stays with this trend, you can see how we're basically pushing a bit higher. The next phase may be a new swing high in the short term. Technology names. So last week we had Net on the long side. This one gapped sharply lower on earnings. I think this is Cloudflare or something like that is the company name. Down 25% on an earnings gap. New idea, Wolf as a breakdown candidate. May 40-50 bear call spread. Expectations here for me would be maybe a mild bounce that you could get short on, or even a little bit of a low base before it breaks down. But ultimately, looks like this stock would work its way lower. Material stocks last week, they highlighted XLB as a sideways trade, and it was perfectly sideways, almost to the penny sideways on the week. New idea would be Cleveland Cliffs as a bear rally. You could wait for this to maybe bounce a little bit further and then trade it as a little bear call or bear put vertical spread. Not expecting too much downside, but maybe a finish below $15 at May expiry. And then last but not least, the energy sector, we had Schlumberger as a sideways idea, and that one certainly was sideways, down about 1% on the week. New ideas would be NOG. This one more bullish and kind of has that cup and handle pattern that we talked about with the S&P. It's very similar here. Out of all of the picks that they highlighted this week, this one is probably my personal favorite. So as you can see, that handle being formed here, possible upside move, and a target of 35 makes sense for kind of a short-term upside move. You could even be a little bit more aggressive potentially if you went out towards June or July and maybe target 38. Why? Well, 32 to 35 is the handle size. Break out above 35 and you should go to about 38 per share. So NOG and a lot of these names in the energy sector that are still within their uptrends are an interesting idea to potentially look at from where I'm sitting. Watch for earnings reports coming out. They can catch you off guard. We had a couple of highlights from last week that actually gapped on earnings. Don't ask your trades to do too much, but overall, the markets are still trending higher. Watch your portfolio allocation, and then, as always, we'll get new videos out. We'll have roundups on Monday, Tuesday, our midweek on Wednesday, more roundups on Thursday, and as always, we'll finish things off with a trading room to see how the week went and to get prepared for the week ahead. Hope you enjoyed this trading room. On behalf of Maverick Trading, I'm Corey Halliday, and we will see you next time. Goodbye, everyone.